Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Schuurmans and Erin Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nik Schuurmans and Erin Varghese work for Pure Portfolios. Any opinions expressed by Nik and Erin or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone and welcome back to another episode of Blind Spots. In a previous episode titled The Pieces of Your Retirement Puzzle, we talked about how your portfolio positioning helps tell the story of your overall financial picture. And once you've settled on your risk appetite, your next move is to create a framework for making investment decisions. So that's what today's podcast is all about.
Portfolio unhinged when investors go off the friggin' rails, right?
Yeah.
Oh no, I'm excited for this because I feel like there's a trove of content on the behavioral bias side with what's going on in financial markets and how investors feel. And I'll provide an example and tie it into our topic today, but I'm writing a blog about it. I just find it fascinating. So hopefully people can start to see some of these concepts that we talk about come to light as they monitor what's going on in their portfolio and financial markets.
So I read a story this week that inspired this topic for me. So Nik has not heard this story yet, but I'm just going to quickly read it. So here we go. The phrase, "just pick a fund," will stick with me forever. I was a recent finance grad fresh out of Washington State University. I got a job under the guise of financial planning for a large publicly traded insurance company. I was giddy with excitement during our weekly sales meeting as I had just signed on my first investment management client. I asked the room of seasoned advisors what their investment process was for allocating new client funds. The room fell silent. I pressed again, this time fumbling over my words. The room erupted in a scattered laughter, and a loud voice shouted out, "Just pick a fund." I knew this approach wasn't for me. There had to be a better way.
So that story is me, and I think that was that story was me, and that was 2005. I was fresh out of Washington State, and I was very eager to do the right thing and make a difference. But I was so green. I didn't know frontwards from backwards, and looking back, just having a weekly sales meeting was a red flag in and of itself. But there were many others that I come to know over time as my career progressed. But I was in a room of a bunch of insurance salesmen trying to allocate a new client's investment portfolio. And these guys were laughing at me because I actually cared about where the money went. And they were like, dude, just pick an A-share fund, throw it in any fund. It doesn't matter. Like, we don't get paid for client outcomes. Like, we don't get paid to do right by clients. We get paid to do stuff, to put them in A-share mutual funds, to sell life insurance, to sell annuities. So that's when I really knew that financial services, especially for entry-level advisors, is really a sales position. And it really is just eat what you kill. It's ruthless. The incentives are stacked against clients. You know, I basically was a commission salesperson. Like, I didn't make any money on salary. It was all about going out and getting new clients. And that was just a moment that's forever seared in my brain. And it probably propelled me on my arc and my mission to start Pure Portfolios and just provide a new way, a new type of environment, a more client-centric, client-friendly environment for people to get clean, objective, professional advice.
Yeah, so that story does not exactly correlate to our topic today, but it inspired it. So we could probably have a whole podcast episode all about how your investment manager is making decisions on your portfolio. But today, I think we're focusing more on the individual investor and decisions that they are making for themselves.
Yes, and just a quick note on clients that work with advisors, not at peer portfolios, but clients that work with, like, let's say a Wall Street advisor, a Morgan Stanley or a Merrill Lynch. Clients would be shocked at what actually happens once they turn the money over. It either goes to a third party, right? So they give it to some mutual fund or give it to some in-house portfolio management team, or the advisor does it themselves, but they're completely winging it. Like they have no investment framework. They're pulling levers. They're trying to bring in business. And it's just really a hodgepodge of investments, a collection of stocks. There's performance chasing. There's random mutual funds. It's like a salad of just random crap.
A good way to put it.
So let's talk about what we mean by an unhinged portfolio. Okay, and having no investment framework. And I think the best way to do this is to invert. So give people examples of what no investment framework looks like, meaning you have no template, you have no plan for making investment decisions. You're basically winging it. Mm-hmm. And there's several symptoms that come of that. And I think a lot of this is happening now. And then we'll provide an example of how that correlates into today. And then I'll talk about what a investment framework actually looks like. And keep in mind, these are more general concepts. They're guidelines. Your investment framework, the way you think about financial markets, the way you buy, the way you sell might be a little different, and that's okay. The point is to have a framework for making decisions so you're not just winging it. You're not being emotional. You're not listening to CNBC or your neighbor or your brother-in-law. So you have a playbook that's specific to you. So I'm a fan of inverting problems like this. So where do investors stub their toe? Where does a well thought out long-term investment plan come off the rails? And it's not just one thing, it's a combination of things. So I'm going to go down the list and talk about these. One, they don't have an information filter. They read everything, they consume everything, and they try somehow to incorporate that into their plan without context. Mm-hmm. So this wasn't an issue, and we've talked about this a lot, but this wasn't an issue back in the 1980s when you had to go to the library to actually find stuff on investing, to find a newspaper on current events. Like now, you've got your phone, you've got social media, you've got everything. You got CNBC, Bloomberg TV, you got the internet, you have all this crap, and it's just spewing a fire hose of information at you. And it could be paralyzing or just overboard if you're trying to weave some of this stuff without context.
Yeah, we had a whole podcast episode on that, and I think it was really interesting and provided a lot of insight into why it's so important to have an information filter. So if you haven't listened to that yet, I would encourage you to check it out.
And so keep in mind, I'm going to be talking about all the things that derail people. I'm also going to tell you how you can remedy these things. So just wait for that towards the end. The second thing, and this is kind of dovetails off the first thing, is people that fall off the rails in their long-term investment plan also have this propensity to act. Like they're always compelled to act. And a few of our clients were conditioned by their previous advisor where the stuff would hit the fan in the markets and they would call us and ask, okay, now what should I do? It's like, look, a big part of a successful investment plan is doing the work today, right? Mm-hmm. Building a portfolio that reflects the way that you feel about risk, having a framework for managing risk, having a framework for overweighting and underweighting asset classes. All of those things are done before something happens. You are doing it wrong if the market tanks by 30% and then you look to make changes. Mm-hmm. The third one, making emotional investment decisions. And again, these are all kind of related. Like you read something, you're compelled to act, you make it an emotional decision. Okay. So this would be like being a 60-40 investor, let's say you're 60% stocks and 40% bonds, that fits with your financial plan, your range of acceptable investment outcomes. Russia invades Ukraine and you sell everything and go to 100% cash. That is a horrible, emotional, knee-jerk reaction decision.
Mm-hmm. I think what people miss when they're making emotional decisions is that they've already missed out on the opportunity. Like, the stuff has already happened. You're trailing far behind.
And the other part of the emotional decision making, like, it feels good to sell. And I've said this before, it's easy to sell. Like, the pain stops, your portfolio is going down, you're seeing red, you sell, all that goes away, you feel great. It's a two-part decision, when to buy back in. And there's no all clear signal to invest. There's always a pile of crap that could go wrong. And there's not this little birdie that comes out and says, okay, everything's all good. We're going to print 15% a year now. It's safe to invest. That does not exist. So if you're a nervous Nelly, that's part of your identity. That's always going to be there. And you're always going to have a reason not to get fully invested.
Mm-hmm. You have a really great blog post on, is there an all clear signal for getting invested, which is good.
Yeah, and it says some of the same things. Like, I've had people tell me, I'm going to wait and see how this COVID thing plays out. I'm going to wait and see what happens with the election and the midterms and yada yada. I'm going to wait and see. Well, by the time you wait and see, the market is looking 6 months to a year to 2 years ahead. Like, nothing happens in financial markets where event happens, then the market reacts. The market is reacting before you've even thought about what you're going to do. Okay. The next thing. So what is that? 1, 2, 3, 4. The fourth thing, performance chasing. So my story I'm going to tell towards the end of the blog really puts a bow on this. And through time, people have always made investment decisions based on what's performed the best. I want to own what's done the best. Well, financial markets don't cooperate like that. It's not so neat and tidy. And history has shown what's performed well today is the worst performer tomorrow. So people end up just getting torched. This is why people feel so bad about this market pullback, this market correction, which is just about 9%. People feel worse now than they did during the peak of the COVID sell-off. And there's a reason for that. And it's called performance chasing. And I'll tie all this together shortly. Number 5, no framework for making buy-sell decisions or managing risk. So people don't have a plan for overweighting or underweighting asset classes. They don't have a plan for when they buy a stock or when they sell a stock. They don't have a plan for when the market sells off by 10% or 20% or 30%, how they're going to react, which leads to emotional decisions, compelled to act, no information filter. So again, these all weave together. The next one, number 6, failure to capture your true risk tolerance. A lot of people think they're risk-seeking investors. The market sells off by 10%. They say, whoa, 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 I didn't mean to take that much risk. Okay. So be honest about your capacity to take risk. All right. If you acted like a lunatic during the last sell-off, you know, that's probably not the correct investment allocation for you. Okay. So go back to the drawing board, be honest about your capacity to take on risk, understand your tangible range of outcomes, right? Don't identify as a balanced investor or a 60-40 investor, because a potential outcome for those types of portfolios could be minus 25%. Okay. And if I said that to you, you'd be like, I'm not comfortable with that. Okay. So make sure you understand a normal outcome for the type of allocation that you have. The next one, and perhaps the biggest, so this is the head of the snake. Okay, all of these other symptoms are a cause of this overarching problem. Rejecting negative investment outcomes. And I've talked about this a lot. I'm not going to belabor it. I'm not going to get worked up. Negative investment outcomes are part of the game. Cost of admission. They're completely normal. You can't enjoy the greatest wealth creation engine of all time without experiencing the pain of occasional loss. It comes with the territory. Embrace it. Okay, the next one, anchoring to an identity. So this is, I've come to notice this more. And this could be in the form of, you think the market's going to tank, you're kind of a doomsdayer, so you anchor to that. And no matter what happens, you continue to anchor to this notion that the market is going to tank. And you can think the opposite too. You can think the market's going to go up forever. You can anchor to that identity.
Mm-hmm.
I mean, if I was to err on the side of one, it pays to be an optimist in this country.
Yeah.
But I'm not saying marrying your investment approach with your identity is a good thing. You need to be nimble. You need to be flexible. You need to be able to change your mind, which is my next point. These kind of go hand in hand. So don't anchor to an identity. Don't identify as a market bull or a market bear or a dividend investor or a value investor or a growth investor. Sure, you can have a preference, but be open to everything. Have an open mind. My next point is be able to change your mind, right? When the facts change, your mind should change. Seek out opinions that challenge your viewpoints rather than confirm them. I think this extends beyond investing, right? A lot of us on social media are spending our time fighting with each other. It's like really understand the opposite viewpoint. And the way this manifests itself in investing, whenever I make an investment decision, I want to understand the other side of the trade better than the person making that trade. So I want to fully understand where my trade can go wrong and understand that someone on the other side who's probably smarter than me has the opposite view. I want to understand that view.
Why do you think that is so important?
Because you cover your bases. It's having that frame of mind. It's more of a mindset. Having that frame of mind means that you're open to the possibility of being wrong. Some of these people I talk to, whether it's a real estate agent about the prospects of real estate or someone talking about a stock or a certain asset class, and they're just hell-bent on the fact that they're going to be right and it's going to go up and they're going to make money and they're going to make their clients money. In order to prepare yourself for every potential outcome, you need to understand all aspects of the trade. You need to understand what could go wrong. And it's just the mindset of a professional investor.
Mm-hmm. Yeah. Okay. Last but not least.
This is really in the last 5+ years, but mixing investing and politics. I mean, one, politics are so emotional. You want to strip emotion out of the investment process. But two, history is not ripe with people that have made political calls, like who's going to win an election, what happens if X candidate passes this bill, and investment success. There's virtually no line. There's no tangible evidence. There's no empirical evidence of that. So people just need to stop. Yeah, it can influence, like there's some headline risk, but like when you look at history between red and blue presidents, who's ever's in the White House, it's virtually indistinguishable between who's sitting in the White House and market returns. I mean, they're basically about the same.
Mm-hmm.
And it's just a lot of fodder. Yeah, great. Talk about it. Do not let your political beliefs leak into your investment portfolio. That's a sign of an amateur.
I think it tends to be one of those hot topics, like you said, like headline risk. People want to have a story for everything, be able to explain everything, and tying politics into it just sounds easy.
Yeah, well, and there are certain topics that affect us all. Politics affects us all. The economy affects us all. The market affects us all.
Mm-hmm.
These affects us all categories are easy to bleed together, and everyone
Mm-hmm.
wants to talk about them. But you really need to set up some guidelines. I mean, we're a fan of evidence. You know, our entire investment approach is designed to strip all this emotion, human bias out of the process. And again, I mean, everything's so charged up on the political front right now. And it's just like, I've seen so many people make allocation mistakes based on politics. And it's just a fatal error.
Mm-hmm. Okay, so you have a story for us, right?
I have zero story. Oh, well, I guess it's not a story. I feel like I've been talking a lot.
That's okay.
Okay. As long as I have your permission to keep talking, then I'll.
Absolutely.
Okay. So I kind of teased this earlier, but this is really fascinating to me. As most listeners know, readers of the blog, I really am obsessed with investor psychology and sentiment and how that impacts stock prices.
Mm-hmm.
And I think what is happening now is it weaves in a lot of the themes that we talk about. It weaves in my earlier comments about having no investment framework. So let's look at what's happened this year in the S&P 500. I'm just going to use that as our proxy.
And for reference, it's February 2022.
Oh, did I say 2021?
No, I'm just saying for reference whenever someone's listening to this.
Yeah. So it's February 22 of 2022. I don't know what that means. That's got to be a sign. That could be good for something, right?
It's Tuesday.
Fat Tuesday, or
No.
I'm just saying there's a lot of twos, and it's Tuesday.
It's Tuesday. It's Tuesday.
Yeah. So go buy a lotto ticket or something. I don't know. Anyway. So the S&P, as of this recording, is down about 9% on the year. All right. Bullish sentiment. So we look at bullish sentiment, and bullish means that you're optimistic about stock prices. So bullish sentiment regarding stock prices is lower today than it was during the apex of the COVID sell-off. So in other words, people are feeling worse today, a 9% sell-off, than they did during the COVID sell-off when the market was down. The S&P was down 37%.
Crazy.
How is that possible?
It's illogical. It's for sure.
Down 9%, you feel worse than when the market was down 37%. So I'll pause, let people think about that. How is that possible? It's possible because people were shoveling money into ARK funds, into Zoom, into Chewy, into Teladoc, into Twitter, into Peloton, into Netflix, into these high-flying COVID economy stocks that were skyrocketing in price and that people were FOMOing into, hoping to make a quick buck. People also took pandemic themes, work from home, gyms are going to be closed, movies don't exist, no one's going to go out to eat anymore. And they extrapolated that out over the next 2+ years. I got news for you. Human behavior does not change that quickly. And that is reflected in a lot of these stocks that I just rattled off. Many of those stocks are down 60+% in the last 6 months. So to answer the question, how is that possible? Why are people feeling worse today than they did during the COVID sell-off? It's because they FOMO'd into all these names and they've gotten their faces ripped off. That's why. Performance chasing, no risk management framework, emotional decision making. They felt compelled to act. They had no information filter. They're listening to their neighbor. They're listening to Twitter. There's no investment playbook. There's no investment plan. And I'm saying this to you from experience. I've reviewed these portfolios. I've met with investors that are feeling awful because they did all these things.
So what about the person that says, okay, like, I'll raise my hand, I'll admit I was the one who was performance chasing. I thought I was going to make the quick buck. I thought that I knew what was going to happen. I thought that I had a game plan. And I jumped ship. Or it just didn't pan out. And now my ship is sinking. Now what?
Well, if they're having that conversation, I think that's step one, because the first thing that needs to happen is some self-awareness, some looking in the mirror. There's a problem here. And you need to ask for help or recognize that at least you should change up your investment approach. So in other words, build an investment framework for making decisions. And at the top of the podcast, I let you all know what no investment framework looks like. Now we're going to dovetail into what an investment framework looks like. So the first thing is having an honest conversation with yourself. You're not equipped to do this yourself. You're prone to all those things that I just ranted off. Okay. So the first thing is building a portfolio that reflects the way that you feel about risk. Okay. So identify your range of acceptable investment outcomes, meaning how much pain can you take? Down 15% in 6 months, down 10% in 6 months. Be very specific. Don't say I'm a balanced investor, right? That leads to mistakes. Be very specific about your tolerance for pain, your tolerance for loss. Build a portfolio that reflects that. That's the most important thing. Versus being honest with yourself. Next, building a portfolio that reflects the way that you feel about risk. The second thing is, and no one listens to me when I say this. Next thing, build an information filter. In 2022, it's the most understated, most important thing that you can do if you're a do-it-yourself investor, even if you're working with an advisor and you still have one hand on the steering wheel, meaning you're telling them what to do. Build an information filter, because 90% of what you read and what you see is crap, especially on Bloomberg TV and CNBC. It's just like, it's made for you to watch. It's like WWE of finance. It's just it's trash.
You think it's real, but it's really not.
It's like some of the people they have on there are very smart. They're very credentialed and accomplished, but they spew nonsense. They talk nonsense. I've sat in those rooms of those people speaking nonsense. It's just it's a big dog and pony show. Okay.
Yeah.
So build an information filter. I get a lot of my information from blogs, from professional investors that I curate on Twitter. We pay for research that's professional, it's objective. And try to read, and if that's too much for you, try to read something that's pessimistic, that's neutral, that's bullish. Okay. Seek stuff out that challenges your beliefs. Like if you think the world's coming to hell in a handbasket, start reading some optimistic commentary. What could go right? Because I can tell you, optimism has been rewarded in this country. I'm not saying that's going to be that way forever, but that's the way it's been.
Yeah, the only thing I would add to that is that you have to be very intentional about creating the information filter, because as the old saying goes, you are what you eat. But with the algorithms these days, the way that social media feeds are curated, it's so easy to fall into this silo of one way of thinking. And the more that you read things like that, the more additional content that's under that same umbrella is going to continue to come up. So you have to be very intentional about the kind of information that you're seeking out, because it's just the way that media is generated these days that it won't come to you unless you go find it.
That's good. The next point, stepping away from every ebb and flow of market moves. Look, I've got an iPhone. I can click stocks. I can see what's moving about. Like I almost had a heart attack when there's talk that the publicly traded stocks and bonds and markets, yada, yada, could go the way of crypto, meaning being open 24/7. So they would never shut down. That would be horrible for investors, in my opinion. So anyway, if you're prone to tracking every ebb and flow of market move, delete the app on your phone, check out, quit watching the news, and just take a deep breath. Okay? Take a deep breath. I already touched on this one, but be honest about your limitations if you're prone to making emotional decisions. If you hire an advisor or work with an advisor, let them do their job. Like you don't need to be holding weekly calls or having them call you to clear trades with you. Like find a good advisor, an independent, fiduciary, professional, credentialed advisor, a CFA, a CFP, and let them do their job. This is all they do all day, every day. If you have a good one, they're worth their weight in gold.
And if you're already working with an advisor and you don't like them or you don't feel like you trust them and you can't hand over the wheel like you feel like you want to or should be able to, that's a pretty good gut check to go seek out other advice. Like if you visit a doctor and you're not getting the information that you want, you would go get a second opinion, right? So the same thing goes for your advisor also.
Yeah, and Erin, you asked me a question a long time ago, because I always rant against Wall Street. There's a lot of bad advisors out there. There's some good advisors too, but there's more bad than good. You asked me who does it well, right? Because pure, we kind of think of ourselves as like the ultimate, which is great. But you asked me who else does it well, and I didn't really have a good answer for you because there's more people that do it poorly than well. But those that
They
do it
just
well,
stick out the most because they're the largest names.
right? But those that tend to do it well are independent RIAs that insource the investment management, have reasonable fees, have credentialed professionals, they're fiduciaries. So folks, go the independent channel. Like, you can't serve two masters. If you're working with a Wall Street advisor, their duty is to maximize shareholder profit. It's hard to do that and do the right thing by clients. Like, it's impossible. You can't serve both.
Yeah.
Anyway,
I think that's a good place to get into our bad actor of the week.
Yeah, let's get into our bad actor of the week, because this is why we do it, to show people that not all advisors are the same.
Okay, so headline this week for our bad actor of the week was that FINRA suspended an LPL advisor for forging a client's signature. Big no-no.
That takes talent.
In any industry, but come on.
So he needed to meet a deadline for the client's RMD from an annuity he probably sold this guy. First denied that he forged the signature, suspended from working in the industry for 2 years, and paid a $10,000 fine. So
here's my first impression when I read this article. I think that as bad as this is, I think that the advisor had good intentions. Because, okay, hear me out. I think that he had decent intentions at least, because since this was attempting to meet a deadline for the client's RMD, it was likely close to the end of the year. As we all know, you have to take your RMD before December 31st, or else you can potentially have some big fines from the IRS. So I believe that he was probably trying to meet that deadline so that his client would not run into this. Did he go about it the right way? Absolutely not. But I have a feeling that he was trying to circumvent the downfall that potentially could happen by not meeting that deadline.
Okay, Erin's just trying to be nice. Of course,
I'm giving him shadow of doubt.
Yeah, you're being way too nice. No one would ever in their right mind do this. It's a huge no-no. We're all trained to know that it's just a flagrant foul of offense. And my only counter to that would be, this is what he got caught on. What else did he do?
Yeah.
Right? Like, he knows this is bad. This just shows that the moral compass is lacking.
Yeah.
And this could open Pandora's box into some other not so good behavior. So this to me is inexcusable. If anyone did this at Pure, they'd be fired.
Yeah.
And to me, this guy or gal should be banned from the industry. I mean, this is just a clear-cut no-no.
The thing about forging signatures of any kind is that you know, or should know, that it's wrong from a really young age. Like, I remember in grade school having to get signatures from my parents that I did my reading, or I did my homework, or they saw my report card, or whatever. And I think every kid goes through like, oh yeah, I don't want to show them this, but I'm just gonna, put a little signature down. And I could never bring myself to do that because I knew that it was wrong. So imagine on such a larger scale, something so much more important, that you're doing this. Like, you're so right that the moral compass is just really off.
Well, and we've all tried to forge our parents' signature. My dad's was much easier, or no, my mom's was much easier to forge than my dad's. My dad had horrible handwriting, which is probably where I get it. But for sure, like, every kid has practiced their parents' signature. And you're lying if you say you haven't. Anyway, okay.
Okay, back to the things that you should do.
Okay. So, understanding the best performers of today are often the worst tomorrow. Again, I don't need to beat a dead horse. People FOMO, fear of missing out, trades, chasing performance, got their faces ripped off this cycle, which is why they feel so bad. Having a criteria for buys and sells. So this is important if you're a do-it-yourselfer, right? So if you're pulling your own levers, you should have a trading journal and capture your mindset, your rationale for making a particular trade, because I can tell you a year from now, after you've made that trade, you're not going to remember why you did it. It's nice to go back and look at your state of mind as you make these trades, especially for large allocation shifts, like going from 60% stocks to all cash. Like, you want to understand your investment mindset, your decision-making mindset.
Yeah.
Embrace negative outcomes. I've said that. Be able to change your mind, seek opinions that challenge your viewpoint, not confirm them. The last point is staying away from extremes. Investing is not black and white. There are shades of gray. There's nuance. This is a complex system. So extremes, I mean, you think the market is going to go down by 80%. At the other extreme, you think the tech stocks that you just bought are gonna 5x in value. Like, those are huge extremes. You'll get tied up into those viewpoints. It'll become part of your identity, and it can lead to allocation mistakes. So know that the truth lies somewhere in between. And again, just try to balance out your extreme viewpoints with the opposite viewpoint, just to stay centered.
Yeah, it's all about that information filter. All right, I think that's a good place to end it. We've referenced a lot of blogs and other podcasts, so those will all be linked in the description of this episode. But thanks for tuning in to this week's episode of Blind Spots. We will see you in our next one.